Hello friends, this is the 8th class of holding company and this is one of the very important problem on holding company, and I hope this particular problem will help you a lot in navigating through the exam. May it be a BCom 6th year Calcutta University or it may be CMA or CS. Definitely this problem will hold as a milestone for your preparation. I hope that you have gone through the question, and if you have not gone through the question, please go through the question, note down the question, start doing the problem with me so that you will definitely understand, and I hope that all of you with all these classes covering, all of you will be definitely understanding the holding company, and we shall also be taken, I will also be taken a lot of more classes on holding company so that this particular chapter from A to Z will be completed. So friends, start with the problem. In this problem, let us come to note 1. In this problem, they have given you in the first adjustment, that is Casters Limited acquired 80% shares in Tika Limited. So degree of holding is given out here. You need not have to calculate separately because this is given in the question, right? Then comes the note 2. In this problem, adjustment number 1, they have given you the date of acquisition of share. Date of acquisition by holding company as 1/4/22, that is on 1st April 22. So friends, if you calculate the number time period between 1/1/22 to 1/4/22, it will come 3 months and the remaining period comes 9 months. So pre-acquisition period is taken as your 3 months and post-acquisition period is from 1/4/22 to 31/12/22. This is your 9 months, right? If you have got any problem in understanding, please give your comments. I will definitely back to you with that clarification. And in the last class, that is on the 7th class, there is one writing mistake in minority interest. The problem is 100% correct, and there is one writing mistake, that is, and I hope on taking the note you will correct that one. I will write this also in the comment, but so far as in the 7th class, so far as the capital reserve is concerned, it is 100% correct, 62,000. Anyhow, let us come to this note 2. The general reserve was 10,000 and the general reserve here it is 20,000 as per balance sheet. So this is also the balance of general reserve is given in adjustment number 1. So friends, the general reserve given is 1,10,000 and in the balance sheet 20,000. So if you see, there is an increase in general reserve by 10,000. So increase in general reserve is 10,000, and from this 10,000 for 3 months it is 2,500, and for 9 months it is your 7,500. General reserve 10,000, the opening balance is a pre-acquisition profit. Similarly, you come to PL, the profit and loss account as on 1/1/2022, as given in your adjustment number 1 in the problem is 2 lakhs. And as per balance sheet, it is 3,60,000. This is given in the balance sheet, 3,60,000. So friends, and they have also given you Tikka Limited distributed dividend for the year 2021. How much? At a rate of 16%. The Tikka Limited share is 5 lakh. So 5 lakh into 16%, if you take the dividend, it comes to 80,000 as dividend. This is the dividend here, 5 lakh into 16%. So 80,000 dividend Tikka Limited paid. Right? So after payment for dividend, the balance remaining is 1,20,000. This 1,20,000 becomes 3,60,000 at the end of the year. Suppose you have got 10 rupees and you paid 2 rupees to somebody. That means 8 rupees is there. At the end of the day, you have 18 rupees in your hand. So during the day, you have earned 10 rupees, 18 minus 8. Similarly, the opening balance was 2 lakh, 80,000 paid as dividend. So the balance remaining is 1,20,000. And this 1,20,000 becomes 3,60,000. So during the year, there is an increase of 2,40,000 in 12 months. So 2,40,000 in 12 months, and 3 months is the pre-acquisition period. So 1,20,000 is a capital, 3 months 60,000, because 2,40,000 is for 12 months. So 2,40,000 divided by 12, 20,000 per month, and 3 months it is 60,000, 9 months it is 1,80,000. Then we will come to the asset. Let us come to the note 3, which is very important, and the value of asset was 4 lakh as on 1/1/2022, and at the end of the balance sheet it was 3,60,000. So 2,40,000, 4 lakh at the beginning, that is 1/1/22, and on 31/12/22 it is 3,60,000. So total depreciation is 40,000. This total depreciation, if you want to find out the rate of depreciation, it is 40,000 by 4 lakh into 100. So rate of depreciation on asset, that is your land and building, this is your coming to 10%, right? So land and building rate of depreciation is 10%. We will find out the book value of land and building after 3 months. So at the beginning it was 4 lakh. If you take 3 month depreciation, 10% for 3 months. So if we take 10%, 40,000, and for 3 months depreciation is 10,000. So the book value is 3,90,000, and this book value as on 1/4/22, the book value of land and building is 3,90,000, but it is revalued at 3,90,000, but it is revalued at 3,80,000 as given in your adjustment number B, right? So there is a 3,90,000 become 3,80,000. Therefore, there is a revaluation loss. So this revaluation loss we have taken here as capital loss in pre-acquisition period. Then here the asset value decrease. That means the company has provided depreciation more. Now the depreciation has to be written back, not written off, it is written back. If depreciation is given more, the profit become less. Now the profit become more for the post-acquisition period. So 10,000, 10%, 9/12. So during the post-acquisition period, 750 rupees profit will increase because the value of asset decrease. We have seen in the previous many problems that revaluation profit, so extra depreciation was provided. Now extra depreciation is not necessary. Here asset value decrease, therefore depreciation will decrease and profit will increase. So increase the profit by 750. So the total comes to 1,82,500, 188,250. Out of this, minority interest is 20%. This is minority interest. Therefore, the holding company share is 80% remaining here. So friends, we know the statement 1, that is your analysis of profit. Let us come to minority interest. This is the second statement we generally prepare. This is statement number 2. This is your minority cost of control. We shall first find out cost of control. This is it may be goodwill or it may be capital reserve. The first step for cost of control is the cost of investment. So cost of investment, that is your cost of investment is 8 lakhs less pre-acquisition dividend wrongly credited to holding company PL. This is 80,000 into 80%, 64,000. This is 7,36,000. Less, friends, this is the adjustment we have done repeatedly. That is the pre-acquisition dividend has been taken into PL of the holding company wrongly. Pre-acquisition dividend is credited to investment account. So now we will make it less from this place and we will also make it less from the holding company PL. Right? So less share capital, that is Tika Limited capital is 5 lakh into 80%, that is 4 lakh, and share of pre-acquisition profit. This is your share of pre-acquisition profit is 1,46,000. This we shall take over here 1,46,000, right? This comes to 5,46,000. Now this is a case of goodwill, because the investment cost, effective investment cost is higher and the book value is lower. So it comes to 1,90,000 positive. Positive is a sign of goodwill here. This goodwill is an intangible asset and it will go to the balance sheet asset side. So 1,90,000 is our goodwill, right? This is very important that we have got cost of control 1,90,000. So friends, let us, cost of control is finished. Let us go to the next statement, that is your minority interest. The minority interest will be calculated like this. This is your statement 3. Minority interest, that is share capital, only 20% share capital held by minority. Capital of Tika Limited is 5 lakh, and if we take 20%, it comes to your 1 lakh. Share of capital profit, this is your capital profit. Minority share of capital profit is 36,500. This 36,500 is the minority share, and 37,650, this is your minority share, 36,500. And $37,650 share of revenue profit, or you can say this is your post acquisition profit, that is 37,650. So friends, if we add this, we will get the minority interest over here. This is your 1 lakh plus 36,500 plus 37,650. Now this is minority interest is 1,74,150. This will go as the last item of your liability side or liability part of the balance sheet. Friends, now we will go for statement 4. This is your holding company, PL, reserve, etc. Friends, this is the statement 4, and this is holding company, PL and reserve. In this case, we only take the balance from the holding company balance sheet, that is Castor Limited, reserve is 9,50,000, PL in Castor Limited it is 8 lakh. This is holding company, PL and reserve. Then share of post acquisition profit, this is a revenue profit. We have taken this figure from the analysis of profit, that is statement 1. Then dividend wrongly credited, it is given in this adjustment, that is your adjustment number 6. The adjustment number C, 16% dividend was paid and Castor Limited credited the entire dividend of Tika Limited to PL account. So pre-acquisition dividend, this is pre-acquisition dividend, 5 lakh into 16%, it comes to your 80,000, and pre-acquisition dividend should be credited to cost of control or cost of investment. It is credited to cost of investment. Instead of that, it was credited to holding company PL. That means in this 8 lakh, 80,000 into 80%, that is holding company share, is included here. So 80,000 into 80% is included here wrongly. Therefore, we have to deduct it from the PL. We have to deduct it from the cost of investment in statement number 2 that we have done. Right? So this is dividend wrongly credited. Unrealized profit. Stock of Castor Limited include rupees 30,000 goods purchased from Tika Limited, and Tika Limited debtor include 60,000 for goods sold. Right? Tika Limited debtor include 60,000, creditor include 60,000 for goods sold. On 60,000, profit is 15,000. They have given you in the adjustment number. This is your adjustment number D and E. In D and E, this adjustment is given, that is creditor includes 60,000. That means debtor also includes 60,000. Therefore, this mutual owing, creditors minus 60,000 and debtor minus 60,000 has been given in the balance sheet. These things are mutual debt, mutual owing. All these things we are doing from lot of classes. But stock include not 60,000, 30,000 remain unsold. Total goods sold 60,000 and profit total is 15,000, but unsold goods is 30,000 as given in your adjustment. So on 60 unitary method, on 60,000, 15,000 profit. On 30,000, it is 15,000 by 60,000 into 30,000. That is 7,500. And if we take 80%, it comes to 6,000. So 7,500 into 80%, that is 6,000 is the unrealized profit. We have deducted from the PL. We will also deduct it from the closing stock, that is stock. we have deducted 6,000 over here. So this is reserve is 9,50,000 and your PL is 8,80,600, right? This is the statement of PL for holding company and subsidiary company merged together. So friends, let us come to the consolidated balance sheet. In the balance sheet, I have shown you the details in the balance sheet itself. You can make a note and put the note number here, and also you can just give the figure. Just like share capital is 15 lakh, this is the share capital of Castor Limited in balance sheet. Reserve and surplus, this figure have been taken 9,50,000 and 8,80,600. This we have taken from the statement 4. So total coming to 18,30,600. This is 18,30,600. Now sundry creditor. Sundry creditor is given and mutual owing 60,000. So sundry creditor figure 2,93,000 minus 60,000, it comes to 2,33,000. And minority interest from statement 3 is 1,74,150. So the total of the liability side is 37,37,750. And below the liability we have to write the assets. Below the liability we have to write the assets, right? And in the fixed asset we have taken the tangible asset at first. And in tangible asset, land and building, this is 10,30,000 and S Limited 3,60,000. Revaluation loss is there, that means value will decrease 10,000. Alternatively, you can write this as 3,50,000. Depreciation written back, this will be added here. More depreciation was given. Now depreciation asset will increase and depreciation will decrease. So the figure is 13,80,750. Now we will take the intangible asset. The heading will be intangible. This is tangible asset. Goodwill is there in cost of control in statement 2. So intangible asset, here we have to write intangible asset. Intangible asset. And this intangible asset goodwill is 1,90,000 from your statement 2. Machinery 3,00,000, 2,71,000, no adjustment. Sundry debtor H Limited, S Limited, mutual owing. This 60,000 here and 60,000 here. This is the mutual debt between Castor Limited and Tika Limited. So the figure is 6,78,000 stock, 3,40,000, 2,02,000. And unrealized profit is 6,000. So the resulting figure is 5,36,000. We have continued the asset over here. Due to space constraint, I have written the asset over here. So other investment, that means it is not an intercorporate investment. Other investment 1,65,000. Cash and cash equivalent H Limited 2,00,000, S Limited 15,000, cash in transit 2,000. Friends, this regarding this cash in transit, they have given you regarding this cash in transit, they have given you, that is your on December 31st, Castor Limited remitted cash 2000 on current account to Tika Limited. So current account in the balance sheet, credit side it is 18,000 and debit side it is 20,000. Current account in the credit side 18,000 in the balance sheet. This is credit side 18 and debit side it was 20,000. Out of this 2,000 is the cash in transit. You make a less here 2,000. So 18,000 debit and 18,000 credit. This will be cancelled. Current account will definitely be cancelled. And this 2,000 cash in transit will come and added in the cash and cash equivalent. So the total of the asset side will be 37,37,750, also 37,37,750. Now this asset and liability is tallied. Friends, I like to tell you we have done this balance sheet putting all the details here. Alternatively, you can prepare a statement, a notes. Note 1 will be share capital and you can put it here. Note 2 is reserve and surplus, you can put the direct figure here. You need not have to show both these things. You can also do that. Similarly, sundry creditor, the working you can do in note 3 and you can put the final figure here. And so far as asset is concerned, you can make a note 4 and all these things you can put it in the note, only final figure you can give. Similarly, machinery you can make a note 5, debtor you can make a note 6, stock you can make a note 7, and other investment you can make a note 8, cash and cash equivalent you can make a note 9. And after making the note, you can put the note number here and put the figure directly, so details are not to be given. Alternatively, you can also provide details here. Balance sheet, Companies Act 2013 is not specifically telling the details, you cannot mention here. So it is a healthy practice to make a note and put it here, but as it is a consolidated balance sheet, therefore I have put it here. You can alternatively make a note and put the final figure here. So friends, this particular problem involves lot of adjustments, and I hope that you will all go through the adjustment and make a healthy preparation on holding company. Friends, if you like my video, please subscribe and offer your comments. You can also refer to your friends, and we will be doing with more problems on holding company, so that keep in touch with the class. Thank you for your patience listening.